Ladies and gentlemen, we ended up talking about the SoFi dilution strategy. However, I didn't actually talk about some of the financials and some of the real problems that I'm having with this dilution. Well, both the benefits and the problems. Let's jump into the strategy and talk about what's actually happening. So, starting with the facts, 54.5 million shares at $27.50 is the total pricing of this offering. Now, there's an additional 15% shares, or about 8.2 million shares, that could be taken out, which almost always is, and in fact was taken out in the last offering that SoFi offered back in July 29th, if I remember correctly. So I do think it's going to be a $1.7 billion raise, which is quite a lot of money for this $30 billion business, especially for the being at the second time that we've seen in the last 4 months. The other concerning part is what this says in their 10Q, which they released on October 28th. Actually, I think it was actually in November because the 10Q comes out a few weeks after. But we believe our existing liquidity will be sufficient to meet our existing working capital and capital expenditure needs, as well as our planned growth for the next 12 months. That was in SoFi's 10Q, which is the exact form that they give to the SEC. This is not exactly how those things planned out. Now, it was true. They did have enough working capital to live out all of their potential growth. So what the heck are they expecting now? There must be a change in strategy. Is it an acquisition? I mean, I don't know. Okay. And for me to speculate on an individual name would be throwing a dart. Like I would have no clue. I'm just throwing it in the dark. Okay. However, I do think that we can look at what they actually said. SoFi intends to use these net proceeds for offerings of general corporate purposes, including but not limited to enhancing capital position, increasing optionality, enabling further efficiency of capital management, funding incremental growth and business opportunities. I think just across the board, there could be a general increase of personal loans, student loans, home loans, paying off debts, and putting more back into customer acquisition. I mean, just general speeding up of progress if they think that they're doing really well with the capital that they have on hand. Let's look at a little cheat sheet here. If they're raising this amount of money, which is $1.5 billion total, if they take out that additional 11%, okay, that's going to be $1.725 million raised. Now, that is going to lead us to 1.35 million total outstanding shares, or about a 4.85% dilution on SoFi stock. But take a look at where this led the stock. On Friday, the stock fell 7%. Okay. The dilution maybe should have taken them down by 4.85% because that was how much we actually diluted by. Okay. But that's not taking into account the fact that we raised $1.7 billion. That should offset a lot of what we actually fell by. However, the stock fell even more than this. So I ended up buying a good amount of shares on Friday during this dip because I thought this was an overreaction to what Anthony Noto has done constantly, which is do a lot better than my expectations. So I have belief in them. With this, if you were to just take a look at the current cost of their debts on warehouse facilities, for which they have about $2 billion in, 5.3% cost of debts would roughly be around $85 million worth of savings, assuming that they put all 1.7 billion towards that. It's around 91 million. But let's just cut it in half and say 85 million, okay? If we look at the current 2025 guidance, this is how these things can be affected. I'm only going to show you a couple things for 2025 and then 2026 as well, because this is quite interesting. This is the current expectation. $455 million in net income. That's SoFi's assumption. And they also are assuming 37 cents of EPS at the current outstanding shares. That's where we were before. With this new amount of outstanding shares, it would bring the earnings per share down to 35 cents. However, SoFi always beats, and people forget this. So if they say they're going to do 37 cents and they haven't put up some preliminary earnings results to change those expectations, that means they are going to beat. They've beaten every single time since being a public company. And as you can see here in these bars on both revenue and EBITDA, those beats have only gotten larger and larger. So dilution and the beat would result in them beating by roughly $30 million in total net income and getting to about 38 cents of EPS at this new count. So this is what I'm expecting now, if not even more. but it'll be interesting to see how this happens. For 2026, they're expecting roughly $775 million in net income if you assume the same amount of outstanding shares before. Wall Street places them at about 60 cents of EPS. So that is the amount of net income required to hit Wall Street's expectations. With this dilution, increasing the total share count, that would bring EPS down to 57 cents, assuming that they make the same amount of money. However, that's not what we're hoping for. Remember, with this additional money that we're saving from the debt costs, okay, from the money that they just raised, that could make them an additional $85 million to the bottom line that would go directly into net income, bringing that net income up to potentially $860 million. So this would actually bring EPS with the new amount of outstanding shares to 64 cents, or a beat on current Wall Street expectations. And by the way, guys, this is just the current guide with current savings of the new dilution. This is not talking about if they actually beat as well. We could potentially end up seeing, north of 70 cents or even 80 cents if they did what they did in 2025, which was every single quarter they beat expectations and then they raise guidance. And that compounded over 4 separate quarters ends up skyrocketing past expectations. So I'm a big believer that we're going to get even past 64 cents next year. So now let's take a look at what this could mean to their Q4 2025 financials. So first up, tangible book value. Cash would immediately go into tangible book value. Cash is king. So this is without even raising up their total tangible book value just by growing their loans and actually making additional profits, which they've done every single quarter beforehand. But these two raises have obviously made massive material impacts. Now, on their risk-based capital ratios, this is the exciting part. Whenever they brought it up to 20%, remember the minimum that they have to have required by law, they need 10.5% of their total amount of money still in tangible assets. And then the rest they can sort of lend out, which means they can lend out about 9.5 times more money than they actually have. That's just how banks can create leverage. So as this rate was falling, as they were getting increased amount of loans on their balance sheet, they ended up raising money, bringing them up to 20%, which then filled the pockets with their ability to then lend out even more money. Okay. So there was no need for a raise at this point. Then this quarter, they did it again, bringing it up to 25%, not seen since Q3 of 2022, whenever we were funding the bank to begin with. Okay. This was the first steps of the bank. No bank in the United States has rates like this. No bank in the United States has 25% capital risk-based ratio. So this is absolutely absurd, and they're not going to keep it this way. So in order to lower this amount, they need to give out a lot of loans just to grow this loan book. And that does not include the loan platform business or selling any loans or the loans that will be repaid. Okay. This is unbelievable. Just to put this into perspective, by the way, in July 29th, they raised $1.725 billion. This time, they raised another $1.725 billion to a total of $3.4 billion. If you end up taking a look at their total loan portfolio, which this is where it is broken down, but if we consolidate it, it's roughly around $33.8 billion total. So you're saying, Tanner, this additional $3.4 billion is not going to make that much of a dent. But like I said, this can be lent out on that risk-based asset ratio of essentially 9.523 times, if you want to get really technical, that amount more than what they actually have. Which means in these two raises, this has allowed them to add on roughly $33 billion of more loans onto their balance sheet, or essentially double where we just were. Quarter over quarter, they've grown their loan book by roughly $2.6 billion. But we originated $10 billion this quarter. How does that work? It only went up by 2.6, but they originated $10 billion. Well, like I said, people are paying off their loans. People do early repayment, not just like on time, but early repayment. SoFi ends up selling off those loans, so they leave their balance sheet. A lot of these originations as well are not even originated on their behalf. This is originated on behalf of other financial institutions, also known as the loan platform business. So 45.4% of their personal loans last quarter were sold on behalf of other institutions, meaning they didn't even use their own capital. So we didn't need to raise any money for that. We didn't need to do anything along the lines of what we just done in the last 4 quarters in order for this product to skyrocket. The amount of money that SoFi has just raised would take them years to start to lend out, unless they wanted to do something different. So potentially aggressively getting into student loans. Home loans are very, very capital intensive as well. Much bigger loan than what we're seeing on personal loan side. And then, if they wanted to scale that up, essentially 10x that product over the next few years, potentially that's why they would raise an additional $3.4 billion, right? So expect massive changes from SoFi over the next few quarters, let alone next few years. And hopefully they don't need to do this again. But if they do, this is just putting a lot more fuel into a very, very fast moving vehicle already. Okay. This is just turbo on what SoFi is already doing. So expanding growth rates, trying to get more customers, and hopefully selling a lot of those loans back to other institutions. And, the cycle sort of repeats itself. Or maybe it is an acquisition. I don't know. These are just my thoughts.